This conference will now be recorded.
So we've completed COD creation and assignment to the company code. This is what we have previously done. Now after this, whatever we need to do, let us try to understand. So I'll give some examples. Let us take this example along with one asset with the practical numbers, and then we will configure the asset accounting from here on based on our example. So what we will do, we'll take something like furniture and fixtures. When you talk about furniture and fixtures, any idea what is this furniture and fixtures? This is an individual asset or nature of asset?
It's an asset class, sir.
The nature of asset.
Nature of asset.
Right? This is called as nature of asset. Now, any nature of asset that you have in your general accounting is called as asset class in SAP asset accounting. Normally, whenever you look at any balance sheet of any organization, under fixed asset, you will be finding furniture and fixtures, land and building, plant and machinery, goodwill, computers, softwares and licenses, motor vehicles, likewise. Now, all these are called as your nature of assets or asset classification. In short, from your asset accounting point of view, these are all represented as asset classes. Now, each asset class will have a different treatment of depreciation. Not every asset you will be able to depreciation at the same rate. Based on the nature of asset, you are going to decide how you are going to charge or how you are going to treat the depreciation. If you talk about furniture and fixtures, now according to our example, we have three accounting principles: Indian Companies Act, Indian Income Tax Act, and then IFRS accounting principle. Initially, we will be focusing majorly on only two accounting principle where we have the financial postings. Out of three accounting principles, two are related to financial postings, one is not related to financial posting. What are those two financial posting related accounting principles? One is your IFRS, second one is your Indian Companies Act. First, we will be understanding the depreciation on or the calculation part relating to these two accounting principles, wherein we are trying to pass the accounting entries. The third one, which is your Indian Income Tax Act, where there will be no accounting entry. We are not focusing on it much now. Okay, we'll be focusing on that Indian Income Tax Act later on because it does not have any posting. Now, assuming furnitures and fixtures. Now, if you take furniture and fixture, point number one that you need to understand here is depreciation treatment. Straight away, I'm talking about depreciation treatment because all other configuration is a simple, straightforward. There is nothing much you need to do with or you need to understand with the config. First, we need to understand the depreciation treatment. Accordingly, we will be talking about the remaining configuration. When we are talking about depreciation treatment, we need to bring two accounting principles into the picture. First one, IFRS, and second one is your Indian Companies Act. Okay, we need to understand what is the depreciation treatment according to IFRS and what is the depreciation treatment according to Indian Companies Act. According to IFRS and according to Indian Companies Act, are these two depreciation same or they will be different in general practice?
Different, sir.
In
Different, sir.
general practice, these two will be different. Now, since we are assuming, let us assume for IFRS, let's assume that this is percentage based, and according to Indian Companies Act, let us assume this is useful life based. This is your useful life based. Now, in which year are we currently in? You're currently in which fiscal year?
2023.
Current fiscal year is 2023, which means when you are implementing or when you're configuring asset accounting, we are not talking about legacy data or data migration asset accounting. We are talking about the straightforward asset accounting. Once you implement or once you go live with your asset accounting, what is going to happen? That is what we are going to talk about now. Let's say you are in fiscal year 2023 and you are in current month or current period. What is our current period? Is June. Correct? According to these two lines, you are currently on June 2023. Am I correct? You are currently on June 2023. And now when we create the asset accounting configuration, when we test the asset accounting, let us take an example that we are purchasing a fresh asset. We will be taking an example as in we are going to purchase a fresh asset. On this fresh asset purchase, how your depreciation treatment will trigger or how your depreciation is treated in your asset accounting. Assuming we are talking about furniture. When you're talking about furniture, first of all, you need to know the breakup or the different individual assets within furniture. If you're talking about furniture, normally you're not going to create an asset by name furniture. You're not going to create the asset with the name furniture because furniture is the classification or group of the asset. Under furniture, you are going to create the respective or individual asset masters. Like you will be creating chairs, you will be creating sofa set, you will be creating workstations, tables, whatsoever. Whatever is part of a furniture category, all those things with the respective name you have to create in your asset accounting within SAP, not by the name furniture. Always remember, you're not going to create any asset by name furniture. Clear? Right, so when you're writing the asset name, you must be able to identify a physical asset with that description. So always make sure the name that you're giving for your asset is meaningful, not the fixed asset or not the furniture in a single line. That is not recommended. That way is not followed in any projects. Let us not follow here also. Let's assume that we are on 10th June currently. Furniture. Now when you're purchasing a furniture, let's write example number 1. Purchase of fixed asset. Let's assume that a fixed asset is purchased. Now I'll say the fixed asset that we purchased is office chairs or office tables. So let me put or I'll simply put sofa set for head office, reception is purchased from, let's say, Bantia Furnitures on assuming 5th June 2023 for 60,000 INR. Clear? Is this line clear, everyone?
Yes, sir.
Clear it? You purchased sofa set for head office reception from Bantia Furnitures on 5th June 2023 for 60,000 rupees. Now this asset is what we have to bring into SAP. We need to make sure the asset master is created properly, your depreciation is posted and calculated properly. Before we do it, first we need to understand how this accounting treatment will happen for this asset purchase according to IFRS accounting principle and according to your Indian Companies Act accounting principle. Now, let me write depreciation calculation. So point number 1, you have IFRS. Point number 2, you have Indian Companies Act. According to IFRS, we decided this is percentage based. Whenever you're talking about percentage based depreciation, there are two methods within percentage. One is your straight line method percentage, the other one is written down value method or WDV method, percentage method. You need to be very clear what kind of a percentage are you talking about, whether you are talking about straight line method percentage or WDV method percentage. Let's say according to IFRS, this is your 15% straight line method. Similarly, according to Indian Companies Act, let's assume this is your 5 years. Now, based on these two accounting principles, we have listed according to IFRS, we are going to charge 15% to straight line method as depreciation, and according to Indian Companies Act, we are going to charge 5 years as useful life. Now, accordingly, let us try to calculate the depreciation figures. Now, to calculate depreciation figures, first thing that you need is APC. First thing that you require is APC. You need to understand what is APC. APC is nothing but acquisition and production cost. In short, this is the value of your asset purchase. Whatever the value that you are purchasing your asset for is called as APC value in SAP. Now, we assumed that we are purchasing the asset for 60,000 rupees. Let us put 60,000 here. Let's put 60,000 here. Now, second one, you need to charge depreciation per annum. Let me put depreciation per annum. Now, depreciation is always calculated per year, which means per annum. Whatever the rate or whatever the method that you have for your depreciation, always remember this is calculated per year. Now, according to this, you have 15% straight line method, which means you are going to apply 15% on this. 60,000 multiplied by 15%. This is your depreciation per annum, which means per year depreciation is 9,000. Similarly, let's calculate per year depreciation according to Indian Companies Act. According to Indian Companies Act also, your APC value is 60,000 because one asset you cannot purchase for two different values. If it is a single asset, no matter how many number of accounting principles you have, your APC value remains constant or APC value remains fixed. 60,000 will become your APC both for IFRS and for your Indian Companies Act. Next one, when it comes to depreciation according to Indian Companies Act, treatment is different because here you are not charging any percentage. Instead, we are charging based on life. For that, I'll put depreciation per annum. Now, for any life, what you need to do is you need to take your asset value, divide by the number of years that your asset is expected to be with you. Now, this is assumed that this furniture is expected to have a life of 5 years. Divide this asset value divided by 5. In short, number of years. If I do this, I got 12,000. So according to IFRS, we got 9,000 as yearly depreciation. According to Companies Act, 12,000 is what you got as yearly depreciation. Now this yearly depreciation will remain constant. Now yearly depreciation will remain constant, which means fixed every year. You need to only focus on the first year and then the last year. First year of the asset depreciation may be slightly different. At the same time, last year of your asset depreciation may be slightly different because you may not be purchasing the asset at the beginning of the year, which means on day one of your fiscal year, you may not be purchasing the asset, and on day last of your fiscal year, you may not be disposing or retiring the asset. So your asset purchase may be anywhere during the year, your asset retirement may be anywhere during the year. So that is why your first year of the asset, last year of the asset may not have the exactly same depreciation of per annum. There may be slight differences based on the date on which it was purchased. Now, according to us, currently we are on fiscal year 2023. Current month is June. Now, we know for IFRS there is a different fiscal year. For Indian Companies Act there is a different fiscal year. Are we following same fiscal year starting for both IFRS and Indian Companies Act, or our fiscal year is different for both?
Different for both.
It is
Different for
different.
both, sir.
So, according to IFRS, you are starting from Jan to December, and according to this you are starting from April to March, and we are purchasing the asset in the month of June, which means according to Indian Companies Act, did we use the asset for full year or no?
No, sir.
According to Indian Companies Act, we did not use the asset for full year. We are able to tell this because the month in which you purchased is not April. If you purchase the asset in the month of April, then we call it as the asset is used for full year. Similarly, according to IFRS, did we use the asset for full year?
No, sir.
No, because according to IFRS, your fiscal year starting from January, but you purchased asset in the month of June. So considering these two statements, do we get full year depreciation in both accounting principles, or you will get partial depreciation?
Partial.
You are going to receive partial depreciation in both the years. Now for that you need to calculate number of months in a particular, number of days in a particular month. According to the number of days that you have used the asset, you will have to charge the depreciation. Now according to this, what we'll do, let's calculate depreciation per day. Let us calculate depreciation per day. Now to calculate depreciation per day, you need to take depreciation per annum, divide this by 365 or 366. I am dividing this with 366. The reason why I am dividing this by 366 is, in my fiscal year variant we have given for February month 29 days. When you count the number of days in a year according to February 29, this is 366. That is the reason we are dividing this by 366. Now let me round this to 2 digits. Okay, this is your depreciation per day, 24.59. Next one, number of days in year 1. Number of days that you have used this asset in year 1 or first year. Now we purchased the asset, we are talking about 5th June. From 5th June till 31st December you need to calculate according to IFRS. Now next one, what I am going to do, I am going to put Jan, Feb until December. I am writing until December, then I am going to put number of days in each month. 31 here, 29 here, 31 here, 30 days here, 31, 30, 31, 31, 30, 31, 30, 31. Now if you take IFRS, according to IFRS, this is where we purchased the asset, right? According to IFRS, let's calculate what will be the number of days that we have used. Now according to IFRS, in the month of June we purchased, so you need to charge depreciation from June month. Now in June, how many, on what date we purchased?
5th.
June 5th you purchased. So what you need to do, you need to include June 5th and then count the number of days in the June. So did we use 25 days or 26 days in June, considering 5th?
26.
We've used 26 days. So I'll put in month of June, you've used 26 days, and from July onwards, you have used the asset fully. So the number of days that are there in a month will remain the same. Now, according to IFRS, number of days that the asset is used for the first year is 210 days, correct? Is this calculation clear? Why 210 I've got?
Yes, sir.
Right, you're only going to focus on the month in which it is purchased, because from the next month onwards you are going to use complete month. Whatever the days you have in that particular month, same days you are going to consider, because you are not purchasing asset every day. Once in a only one time you are going to purchase an asset. That month in which you purchased the asset might have slight differences in the days. From next month onwards, you are going to take the complete days of a month until the last month in which you are removing the asset. Now, next one, if you take Indian Companies Act, according to Indian Companies Act, you are going to start counting from April onwards. You are going to start counting from April onwards. So when you're counting from April onwards, you have to count until March, correct? When you're counting from April, you need to count until March. Am I correct?
Correct, sir.
Yes, sir.
Now, this is the same thing here. You purchased in the month of June. You are going to take 26 days. It is not going to change. Am I correct? In June month, either if you take IFRS or you take Indian Companies Act, number of days that you used in June month is 26. Any doubt with this 26 days? Because date of purchase will not be the different or will not get changed according to Companies Act or according to IFRS. Because in both the scenarios, you are going to take 5th June as your purchase date. Considering 5th June, in the month of June, you have used 26, and from there, you are going to start your counting as usual. And you're not going to stop at December because your year ends at March. So Jan, Feb, March, you are going to take these days, and overall, if you count, you've used 301 days in this. Is this calculation clear?
Yes, sir.
Yes, sir.
Now, understanding this number is very important. If you are confused with this number, we are not going to understand how system is bringing the numbers in SAP. This is your first point that you have to understand before you configure or before you create an asset, before you check the values in SAP. Clear with this? Now, number of days in year 1 is 210 and 301. IFRS is 210. Let me put these two here. Depreciation per day here will be 12,000 divided by 366. Let me take this also into 2 decimal. Number of days, we got 301 days. 301 days. Clear till here whatever we have updated on the screen? Any questions? Clear with this, right? Okay.
Yes, sir.
Now depreciation value in year 1. We need to calculate depreciation that system is going to bring for year number 1. So here it will be per day depreciation multiplied by number of days in year 1. So your first year depreciation will have to be this much when you create the asset in SAP. Right, first year depreciation will be this, and depreciation value in year 2 will be 9,000. Clear? And year 3 will be 9,000. These three figures clear, understood? Are these three clear? Year 1, 2, 3.
Yes, sir.
First year there is a difference, or there is a less amount because you have not used the asset for the full year in year 1. Based on the pro rata, you have calculated a depreciation according to the number of days the asset is used in that particular year. From second year onwards, your asset is used in the company for the full year, so you are charging the complete yearly depreciation from year 2 onwards. Your per annum depreciation is 9,000, year 2 depreciation is 9,000. Your per annum depreciation is 9,000, year 3 depreciation is also 9,000. It will be the same amount until you are going to retire or until you are going to remove the asset from your company. As long as asset is with you, which has the remaining life, you are going to charge same yearly depreciation. Now let us try to find out the figures from Indian Companies Act. According to Indian Companies Act, you have used 301 days. Now depreciation value in year 1 will be depreciation per day multiplied by number of days in year 1. This will be your first year depreciation. This will be the year 1 depreciation. Now next one is the same, depreciation value in year 2, depreciation value in year 3. How much we are going to get in year 2 and year 3?
12,000.
You have to receive 12,000 here, you have to receive 12,000 here, correct? We need to receive 12,000 for both second year and third year. From here onwards, every year it will be 12,000 until your asset becomes 0. Until the asset value becomes 0, or until you are going to retire the asset. Clear with these calculations? Now this one we are going to consider as a test case or test script or your business requirement for creating remaining configuration of asset accounting. Now when you complete your asset accounting, when you create the asset master, you need to ensure that you are creating the asset master with the name of sofa set for head office reception. Exactly, this is what you are going to write as your asset description, sofa set for head office reception. And then you are going to purchase the asset from a vendor called Bantia Furniture. You need to ensure a vendor account is created by name Bantia Furniture, and you need to ensure you are purchasing the asset on 5th June, which means your purchase invoice will be posted on 5th June 2023. Your purchase invoice value will be 60,000. When you pass this entry in SAP, you are not going to do any other calculations on the system. All the calculations related to asset accounting is calculated by the system automatically based on your configuration. Once you post an asset transaction, which means the purchase of this transaction, all these numbers will be displayed by the system by default. What we are going to do, whether whatever the calculation we have done on the Excel sheet is the same number appearing on your SAP asset account or not, is what we are going to verify. If the same numbers are coming, our understanding is correct. If there is any different number is coming, even if it is 9.3, 9.4, we need to understand why there is a difference of 0.1, 0.2. SAP is also doing the calculation, you are also doing the calculation. So SAP calculation, your calculation must be exactly the same. If there are any differences, you need to understand why there is a difference. So we must know the reason why there is a difference, so that it will be easy for us to understand in case of any issues and in case of any explanation, clarification that is needed by your client or by the user. Whatever you are able to see on your screen, any confusion, any doubt on this part?
No, sir.
Okay. Now, next one, after this, what we need to do? We need to proceed with the remaining configuration. Before we proceed with remaining configuration, we need to understand GL accounts. GL accounts in asset accounting. What kind of GL accounts we normally require in asset accounting? So we're not writing all the GL accounts. We will be writing the GL accounts that are mandatory initially. The different GL accounts we will be adding based on the scenario, based on the different requirement. We will be adding additional GL accounts. First one that you require is APC GL account. When you talk about APC GL account, this is your asset main GL account. If you're talking about furniture, furniture account will become your APC GL account. If you're talking about building, building account will become your APC GL account. If you're talking about vehicles, vehicles will become your APC GL account. Next one, accumulated depreciation. First one is your APC GL account. Next one, accumulated depreciation account. And one more thing that you need is asset technical clearing account. Next one, depreciation. Next one, sale of asset. Next one, profit on sale of asset, loss on sale of asset. Next one, scrapping of asset. How many we have written? We have written 8 GL accounts so far. Now, asset APC GL account, we need to understand whether this is a P&L account or a balance sheet account. Asset APC GL account, this is a balance sheet account. BS represents balance sheet. This will be your balance sheet account. Accumulated depreciation, is this P&L or balance sheet?
Sir, balance sheet.
This is a balance sheet account. Asset technical clearing account, is this P&L or balance sheet?
Balance it.
Balance sheet.
This is a balance sheet account. Depreciation,
P&L.
P&L.
this is a P&L account. Sale of asset,
P&L.
sale of asset is a P&L account, correct? Profit on sale of asset,
P&L.
Profit.
this will be a P&L account. Loss on sale of asset,
P&L.
P&L.
this will be a P&L account. Scrapping of asset,
P&L.
this is also P&L account. Now, first what we have listed out, we have listed out the nature of account, whether this is a P&L account or balance sheet account. Is this clear? Which is P&L account, which is balance sheet account?
Yes.
When you're talking about balance sheet contains two things: asset, liability. In balance sheet, is this asset or liability?
Asset.
Assets.
In balance sheet, this is your asset. In asset, is this a normal account or a reconciliation account?
Reconciliation.
Con account.
This is a recon account. Clear? Your APC GL account is balance sheet asset reconciliation account. Similarly, your accumulated depreciation also balance sheet asset reconciliation account. Correct?
Yes, sir.
Yes,
What
sir.
about asset technical clearing account?
It's a liability,
It is
sir.
It's a liability.
Technical clearing account also you can create under balance sheet asset reconciliation account. Now depreciation, P&L, income or expense?
Expense.
expense.
P&L, this is an expense. Sale of asset,
Income.
Income.
this will be income. Profit on sale of asset,
Income.
this will also be income. Loss on sale of asset,
Expense.
this will be expense. Scrapping of asset,
Expense.
expense. This will also be expense account. Now, before we proceed with the further configuration, we need to ensure these GL accounts are created. These are minimum GL accounts that are created for your asset accounting. Now, when you're creating a GL account, there are two ways. Option number one, you are going to create common GL account for all the assets, or separate a GL account for each asset. When you're talking about common GL account or a separate GL account, we are talking about asset classes. Currently, we are talking about furnitures. Let's say I'll put some other few more things here. I'll put furnitures, buildings, machinery. Now, when I'm talking about APC GL account, can I use only one GL account to represent furniture balance, building balance, machinery balance, or I need to have separate GL account to represent each nature of asset balance? So in short, do
A
we need separate GL account or a common GL account?
separate.
You must require a separate GL account. So which means for APC GL account, you are going to create, if you have three asset classes like this, you are going to create three GL accounts here: furnitures, buildings, machinery. Accumulated depreciation, is this a common account or a separate account?
Separate accounts.
Separate.
This will also be a separate account. In short, accumulated depreciation furniture, accumulated depreciation building, accumulated depreciation machinery, and so on. Asset technical clearing account, is this common or separate?
It may common. It may be common.
Commons.
This is common, right? So let me put here, this will be separate, this will be separate, this is your common GL account. What about depreciation?
Separate.
Separate.
Depreciation also we need to create separate. You can also create this as common, but normally we do not recommend common. We will be recommending separate GL account, so that tomorrow if you wanted to know how much depreciation is posted so far on furniture or any other asset, it will be easy for you to pull out the data based on the GL account. If you are using same GL account for all the assets, it is difficult for you to identify how much depreciation is posted for buildings, machinery, and so on. Sale of asset.
Common.
Sale of asset will be common. Profit on sale of asset,
Common.
this will be common, correct? Loss on sale of asset,
Common.
this also you can create common. Scrapping of asset also you can create a common GL account. In short, you need to ensure depreciation GL accounts are separately created. Asset APC and accumulated depreciation is separately created. These three are mandatory to be separate. The remaining GL accounts is optional. But this is for sure common account. But the remaining GL accounts, if you want, you can create a separate account or you can create common GL accounts. Clear? Any question?
Sir, the asset
Any
technical
questions on
clearing
this
account,
GL
how?
assignments?
Sir, the asset technical clearing account, how can it be a asset accounts?
This you can create under anything. We're just creating under balance sheet, but you can create under balance sheet either asset or liability, or under the GL account group called, we have created technical accounts, takeover accounts.
Yes, sir.
There also you can create. But in short, the core point is it has to be a balance sheet account and a reconciliation account. The group, whether you want to take it under asset or liability, is your choice. Because technical clearing account will become zero or will have zero balance at every given point of time. That's a dummy posting. Okay, so when we are
Understood, sir.
purchasing the
Thank you.
asset, so we will understand how postings are going into this technical clearing account and why this is used. We will practically see when we are posting the asset acquisition or purchase account. Clear with this, right? Any questions, doubts? Clear whatever we discussed so far? Any questions till here you can ask. No questions? Alright, if no questions, let's stop this here today and we'll continue from the remaining configuration from tomorrow onwards. Make sure everybody will create these GL accounts that we have listed currently, and you are going to have your own example. Whatever the example I have given is for a furniture, you try to take another asset, maybe tables, chairs, whatever it is, right? And create or take another different vendor, take a different date, take different amount. Change everything. Your asset name should be different, purchase date should be different, purchase value should be different, vendor should be different. Clear? Don't just change the amount, don't just change the vendor, don't just change the name, change everything that is there on the example here. Clear?
Yes, sir.
And make sure
Yes,
you
sir.
are able to find out the numbers, and in your company code I want you to create not this asset which I am going to create. I want you to create your own calculated asset, and I want you to verify whether whatever you did, whatever you understood is right or wrong from your asset screen after posting the first asset. Okay,
Yes.
all right, then
Sir,
let
I
me
have
stop
few
this record.
questions, sir.
One sec.
Yes, sir.